Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll track the Sell America trade on Wall Street as stocks, bonds, and the dollar continue their sell-off. Plus, we'll look at the health of home builders as Toll Brothers tops estimates. Is the consumer holding up better than expected? We'll discuss. We'll also dig into the tech trade on Wall Street as Google looks to keep its dominance in the search with new AI products. All of that and more coming up on Catalysts. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, we are continuing to see a little bit of pressure across the screen here. You've got your S&P 500 off about 0.5%, your tech-heavy NASDAQ off about 0.3%, the Dow taking it more on the chin this morning here. But let's flip it over to the bond market, which we've been keenly interested in as a potential headwind to stocks as you continue to see yields lifting higher, a little bit of a sell-off happening there. Yields on the 10-year up about 5 basis points. The question is, do those yields start to look a little attractive and lure away some of the stock market? Investors will continue to cover that question for you here. But finally, let's take a look at Bitcoin. It is up on the day above that $105,000 level. It's up nearly 3%. I want to bring in my guest host for the hour, Brian Levitt, a global market strategist with Invesco. Brian, it's always great to have your insights, and I'm excited to prepare for the holiday with you because I want to know if investors need to go ahead and cancel their vacations now. Is there any huge volatility elephant in the room that maybe we need to not ignore?
Well, let's not cancel our vacation plans, right? They're probably for most people in a couple of days, so we shouldn't be making huge swings in our portfolios over a couple of day period. You know, volatility is always the result of policy uncertainty, and we saw that with the tariffs, huge spike in volatility, and then it came down when the market got a sense that the president had reached peak policy uncertainty with regards to tariffs, and we'll start to incrementally improve it. I mean, we're dealing with a little bit of policy uncertainty right now with regards to the big big bill.
Tax bill.
What do we call it? The big
beautiful bill.
The big beautiful bill,
yes.
right?
Yes.
And so, interestingly enough, the volatility index hasn't spiked. It's really showing up more in the bond market. But no, I wouldn't be going to cash or getting rid of our vacation plans.
Can we talk about the bond market then?
Sure.
To what extent do you start to see this lift in yields being a potential headwind for
stocks?
stocks?
It does. It becomes a potential headwind. And, you know, at some point we have to see, it goes back to the old James Carville line where he wants to be reincarnated as the bond market so he can come back and intimidate everybody, right? Yeah. And so at what point does the bond market start to intimidate? You saw this the morning of April 9th, where it looked like we were getting some cracks in the bond market. That was a little bit of a frightening morning. And then you got the 90-day pause on tariffs. Now, so it intimidated the administration into doing something different. Now, that's the challenge investors have. We talk about, you know, do you want to go to cash? The market was up 9.5% that day, third best day in the S&P 500 since 1957. So you miss those days, your long-term returns are eroded. So we'll see how this plays out. But yeah, bond yields going higher, it becomes a little bit of a headwind to equity valuations. And the broad S&P 500 is overvalued compared to its average. Makes sense for investors to think about how they can perhaps bring the valuation of their portfolios down.
It makes me wonder, too, how the tax bill folds into the bond versus stocks conversation because, okay, getting the tax cuts extended, that's a lift for stocks, but if the deficit concern is also a concern for the bond market, then does the bond market volatility off of the tax bill become a headwind for stocks? You know what I mean?
Yeah,
How do you think about that?
So far, the bond auctions have been okay, right? People have been worried about the deficits. I mean, look, I've been hearing about concerns for the debt since we were at $5 trillion. We're now at $37 trillion. So it has not been a huge issue, but directionally, we know this bill will lead to a deficit going higher. Do you see a significant pickup in economic activity as a result of it? Perhaps, although a lot of tax savings tends to be saved, not spent.
Right,
so,
exactly.
So the higher rates put a little headwind on equity valuations, but at some point, when does this become really attractive for investors to step back in? I'm old enough to remember 6 years ago when people were begging for 4%, and you had to lend money to governments like Russia to get 4%.
Yeah.
Now you can get 5 and 30-year U.S. Treasuries. So I'm assuming that there's a point where demand starts to come back into these markets pretty significantly.
And I'm actually just seeing a headline crossing on the EU preparing a trade proposal for the U.S. to steer momentum into talks. This reminds me of a lot of the trade headlines that we've gotten, concepts of a negotiation, of a framework, of a talk. To what extent is the trade war not being fixed yet a potential headwind for stocks, given that we don't actually have deals? Or is the fact that we are past the Liberation Day announcements enough?
Well, we probably need another catalyst for stocks here. So the way I think about it is markets correct when you have policy uncertainty. So February and March, the administration was talking about tariffs. Then as we moved towards Liberation Day, the market wanted to rally into it, expecting a better outcome. We got a worse outcome, at least from a market perspective, where we got reciprocal tariffs and not a lot of clarity. So each piece of incremental news has been viewed positively by markets, right? But we're not at a market high, right? So we're clawing back from a market saying could be a recession, a crisis, to okay, a garden variety correction, to okay, maybe we'll keep getting better news on this front.
Yeah.
It doesn't have to be fully baked, right? I mean, the market did great in 2019, and we didn't get the phase one deal with China until early 2020. So it doesn't have to be fully baked, but the market's going to want to see incremental improvements, and most importantly, incremental clarity.
Yeah. And really quickly before we move on here, I know that you are an advocate for looking outside of the United States when it comes to equity exposure. Where are you seeing that opportunity?
So I would see it in Europe and the emerging markets. I mean, the way to think about this is we've been in a very strong dollar environment, rightfully so. The U.S. has been among the world's or the best performing part of the world. So you get valuations that are a bit elevated. Valuations aren't a timing tool. Strong dollar isn't a timing tool. But what starts to happen now is you get some price impulse. I don't want to really call it inflation, stagflation. You get a price shock in the United States.
Yeah.
So the Federal Reserve can't do that much about it. You get more deflationary impulses outside of the United States. I mean, the simplest way to think about it is we're not going to have enough stuff. They're going to have too much stuff.
Yeah.
And so the European Central Bank's going to have to lower rates. China's going to have to stimulate the economy. So if you adhere to the notion of I don't want to fight the Fed, you probably don't want to fight the European Central Bank, the Bank of England, the People's Bank of China as well. Plus valuations look attractive. So you finally have a catalyst for those parts of the world, and you can bring down the valuation of your portfolio.
Hey, why not?
Why not?
Take it if you can.
Yeah.
Ryan, thank you so much. You're going to stick with us
My pleasure.
for the hour with those insights. Appreciate it. Let's hone in on the so-called Sell America trade. The dollar moving lower today, retreating from some of the positivity we saw earlier in the month. Our next guest is saying the recent run-up in the dollar was an opportunity to sell. Let's get into why with Jayati Bardwaj, FX and macro strategist at TD Securities. Thank you so much for being here in studio. We really appreciate it. I know that you expect the dollar to fall by another 5% by the end of this year. To what extent do you see that as perhaps a cushion for stocks and kind of operationalize that relationship for me?
So what's interesting is actually that we've been hearing for the last 5 years the dollar is overvalued. In fact, for the last decade, the dollar is overvalued. But interestingly, the dollar's overvaluation has actually dovetailed with foreigners piling money into US assets, particularly US equities. For the longest time, people could just hold US equities unhedged because they would also get a very strong dollar rally to support their portfolio. But now that's not the case anymore. In fact, even if SPX might have tried to jump back to levels pre-Trump, but the dollar has not regained any of its strength. In fact, I think investors now have a very strong reason to hedge their long US asset exposure, and the dollar is no longer behaving like a safe haven, unfortunately. I would say it's actually following much more of an emerging market playbook, which is, I think, the unfortunate truth that we need to come to terms with.
And I think that's such a fascinating and important point. Do you see the United States behaving like an emerging market right now from an asset class perspective?
Absolutely, because when we're talking about this big, beautiful bill, it's actually also leading to a big deficit concern. We're not addressing the problem that Trump said he would start out to address. And that's actually feeding into risk premium into both the bond markets, which is why yields are higher, and there's also clearly risk premium in the FX markets, which is why the dollar is really struggling to rally here. In fact, the euro is now stepping up as the liquid alternative safe haven, as you mentioned, in equities because of attractive valuations, but also in FX because it is cheap, and it is now the other safe haven that people are now looking towards.
Now, I can hear investors getting nervous as you're speaking about the United States behaving like an emerging markets. Let's put a finer point on this. Do you think that the current mix of policies has the U.S. behaving a certain way within markets, or are you suggesting that long-term U.S. Treasuries will be treated more like a credit rather than, you know, its own asset class and a safe haven security?
I think that is the next biggest question that we are trying to answer for clients, that if we're talking about a big confidence shock, which you've seen, you know, remnants of that, the way markets have been behaving, the volatility associated with current administration's policies is a big confidence shock, which is actually forcing other countries to step up their local fiscal policies, work on fostering stronger trade relationships amongst themselves. Europe and China are now talking to each other. It's also forcing other countries to think about self-sufficiency and cutting dependence on the US. The gap between the US and the rest of the world was extremely wide for the last few years, but now that gap is shrinking from both ends. US owing to its policies and the volatility around it, and now the rest of the world is being forced to introspect and or do better on their own accord. Yeah. Now that gap is shrinking and there's more opportunities to diversify. Now, in terms of diversification, unfortunately, those kinds of moves take quarters, if not years, to play out. That's why we think that the next move lower in the dollar will not be as rapid as Q1, because Q1 was a very rapid positioning adjustment, but the next move will be structural, which will play out over the coming quarters. And that's why we think you could get another 5% move lower in the dollar by the end of the year.
Now, that sounds a bit more like a recalibration from a place where the U.S. was the only game in town to now there's other parts of the world that are going to benefit from this mix of policy. So back to it's a recalibration that is healthy, or is it an existential threat to the United States?
I think it's a healthy recalibration. Like, we've been doing so much digging into capital flows data, but it does seem that almost most of the money managers, pension funds, sovereign wealth funds, all the global savers of the world have actually been extremely overweight US assets, and that has actually ballooned since COVID. I actually think it's a healthy recalibration, because for the longest time, everything, in fact, most markets became a pure US move and a pure dollar beta. But now you can actually start to focus on local idiosyncratic stories. You can focus on where are the valuations within emerging markets. Can Asia now rise up over Latin America? I think local interest stories will become interesting after a very long time again, which would actually make, you know, markets look elsewhere outside the US. I'm not saying the US will give up its crown position, but I would say maybe other prince and princesses start coming up on the shore and on the horizon.
Well, as we wrap up, Jayati, help our audience learn how to spot those princesses of the market coming up here. You talked about it a little bit, but what should the retail investor activity on this dynamic that you're describing look like?
I think the focus should now be on which countries are now have a lot of fiscal firepower to increase spending, local spending, and which countries also have a lot of power to repatriate flows locally back to their own domestic economies. I think that's where, to us, Europe, as Brian mentioned, and also Asia actually stands out. For the last 3 years, everyone has been long Latin America and short Asia, because we were in the chase for the carry trade, we were chased for the US exposure, and we were also in the chase for the long commodity exposure after Russia-Ukraine. But now all of these three factors are not working. In fact, we're moving in the opposite direction, which is where all of the undervalued currencies in Asia and also in Europe can now start to see impressive performance, especially if the Fed starts to ease interest rates again towards the end of the year.
Jayati, really great overview. Thank you so much for joining us. I hope you'll come back. Really appreciate it. Thank you.
Thank you so much for having me.
We're going to have all of your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. now time for some of today's trending tickers. This morning we're watching Wolfspeed, Moderna, and Palo Alto Networks. First up, the Wall Street Journal reporting Wolfspeed is preparing to declare bankruptcy in the coming weeks. Shares of the semiconductor manufacturer falling over 60% after that report. They're down now over 70%. Earlier this month, Wolfspeed issued a weak revenue outlook and shared it was exploring options for restructuring its debt or potential bankruptcy as it faces slowing demand and what they call tariff-related uncertainty. Brian Levitt's still here with us, and obviously this comes as semiconductors in general have been experiencing at least a little bit of volatility, you could say. To what extent do you think this is some kind of signal for semiconductors versus something specific to Wolfspeed?
Well, I think it highlights the notion of increasing competition out of China, which is something that we forget about this year, right? The DeepSeek story was a big deal early in the year, and we forgot about it because of tariffs and because of the big, beautiful bill. So that becomes more of a challenge, but you're also seeing some of it is more cyclical. A company that had a significant debt level that's now facing slowing demand in certain parts of the economy. So I don't think it means that this is the end of the line for U.S. semiconductor businesses. It's a little bit more idiosyncratic to Wolfspeed, but certainly also reflective of the increased competition in the space.
Yeah, and I take that point too with regards to what we heard from Jensen Huang as well, talking about how these chip curbs, they're kind of making the competition easier for China instead of harder. So it's definitely an important context to keep in mind. But next up here, we're going to talk about Moderna confirming it is voluntarily pulling its application for a combination flu and COVID vaccine for adults 50 years old and older. In a statement, Moderna confirming it plans to resubmit the application after receiving additional results from a phase 3 trial on its mRNA flu vaccine that is expected this summer. And earlier in the month, Moderna said it was seeing potential approval for the shot coming in 2026. Those shares off just about 4%, but it makes me think more broadly, Brian, about what we're seeing in the healthcare sector and a little bit of the underperformance that we've seen as well.
Yeah, there's a lot of uncertainty in that sector in terms of where I think we should do a shot every time we say uncertainty
right,
now.
Exactly. It'd be a tough show. We'd have to wrap 5 minutes in.
Maybe it'd be more fun.
Yes, exactly.
But, where are we going with regards to the pricing of these drugs, in terms of the approval of these drugs? I mean, you hear even some analysts are saying now that they're talking to businesses where they'll call the FDA and nobody's answering the line on the other side. So there's some challenges in that. That's a bit of a headwind to the sector.
Right, and a sector that was supposedly going to be this safe haven area of the market.
Sector, right?
And then, of course, you got pharma tariffs still unfolding here. All right, finally, shares of Palo Alto Networks falling after the company's third quarter results disappointed investors. That is despite the cybersecurity company's earnings and outlook coming in line with expectations. The stock off nearly 7% here, and this comes after a slew of headwinds for this company. I just want to take a look at the performance. Year to date, it is still just above the flat line, but it hasn't necessarily borne out the success story for investors that we were once looking at the prior all-time highs here. And it makes me wonder how you're thinking broadly about cyber in this moment as well.
It's still a long-term structural trend. I mean, cybersecurity is not going to become less of a problem. It's going to become more of a problem in the years as things become more automated, as artificial intelligence becomes a bigger part of our lives. I see this as a long-term structural growth trend.
Yeah, and certainly a sector to continue to watch. For our audience, you can scan the QR code below where you can track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. Well, coming up, we're going to continue to bring you all of the market action, so stay here for more. You're watching Catalysts. Lowe's moving to the downside, off about 1.5% after topping first quarter earnings expectations and reaffirming the full year forecast. The home improvement retailer CEO saying investments in tech and inviting store environments helped offset near-term uncertainty and housing market headwinds. Joining us now, Scott Mushkin, R5 Capital founder and CEO. And you have a sell rating and a $220 price target on Lowe's. Talk me through the price action this morning, because originally we saw a little bit of a move to the upside off of this earnings print that was better than feared. And now we're seeing this move to the downside following the call. What did investors hear that they didn't like?
I mean, I don't think they heard necessarily on the call anything they didn't like. I mean, I think the business is kind of stuck in neutral. I think the concern really, if you look at that 10-year bond, I mean, it's housing is, again, kind of stuck. And without housing getting a move on, it's kind of hard for Lowe's to have good results. Same thing for Home Depot. I mean, both companies are managing well, given what's going on with the consumer, and in housing. But without the rates coming down, I think it's very hard for people to get excited about these stocks.
Yeah, that's. Oh, sorry, Scott. Go ahead. Go ahead.
I was just going to say, then of course you have the tariff background,
Yep.
potential of recession. I mean, there's a lot of overhang here.
Yeah, and it's a great framework because it points to the fact that not a lot of this is necessarily in the executive suite's control. Is the bond market the key indicator for the share price of Lowe's going forward?
I think it's a big indicator, but I'd also say macro. Besides the bonds matter a lot. The other thing I would note during this earnings season, which our research and consulting business would actually disagree. We have a large consulting business. We actually think there has been pull forward of demand. So when you look at the results by a month, and Home Depot did better, Lowe's did a little bit better in April. You gotta, I think, look at that with the idea some consumers were purchasing in anticipation of tariffs. So I think what our concern in the C-suite is they're maybe underestimating that, and that goes even for like Target, which is having a huge down day today. That we do feel like there was pull forward in demand.
And my guest host Brian Levitt has a question for you, Scott.
Hey, Scott, if you look beyond just the near term, obviously the move in rates and the tariff uncertainty, you think about the fundamentals. Is this a country where the fundamentals still look positive in terms of the demographic mix, in terms of the housing supply and the housing investment that'll have to happen over the next number of years?
Yeah, that's something we actually wrote to this weekend to our clients. One of the things as you look at, we called it, it's been a heck of a good 30 years in retail. Part of what's happened with the offshoring is you've had a lot of deflation in goods. That spurred tremendous demand, and you almost say over demand. As we unwind some of that, you wonder where consumers are going to channel their spending. I mean, if you look at growth in durables as a percentage of consumption, of real consumption, it grew from 5.5% 30 years ago to 13% today. I don't know if it goes down from here, but it's hard to understand if it goes up. So this is a really good question about retailers generally speaking. I mean, if you look at Target, which we talked about, there's been an insane amount of growth in some of their core categories over the last 20 years or so. You wonder what's going to happen in the backdrop where you have an administration saying, hey, we need to reshore. Maybe we don't need 20 pencils, we can get away with 3. I think the dynamic on retail over time is not nearly as constructive as it was, say, 15 years ago or even 5 years ago. So it's an excellent question, something we've been talking to our clients a lot about.
It makes me wonder then, Scott, what is the headline story of the American consumer's response to tariffs to come out of this earnings season thus far when it comes to those retailers?
I think the headline coming out is kind of status quo. We haven't really seen the impact of tariffs. We haven't seen the consumer moving much of their spending, except the pull forward I mentioned. I think as we get into the summer and into kind of the back half of the year, and then of course we have the big beautiful bill, some tax changes. Also, I would just emphasize, watch those bond yields. Bond vigilantes was a big term back again 30 years ago. We have a lot of debt, and people got nervous about that about 3 or 4 weeks ago. So definitely watch the tax bill. Definitely watch the bond yields, and then unemployment. That means the most. So I think right now, it's fine. Maybe not great, pull forward, but I think the next 6 months are going to be very telling how things break for probably the next 18 months.
Scott, will it look different to me and to consumers when we walk into these stores? I mean, you hear these stories about empty shelves. You hear some people even warning about long-term stagflation, which I certainly wouldn't be in that camp. But empty shelves and price shocks, is that what's in our future over the next months?
As I mentioned, we have a consulting business. If you look at a retailer, a good retailer, they call it facing over. So what they try to do is fill in those shelves so you don't really see a lot of missing product. And there may be some of that facing over as it gets harder to get certain items. But I guess to the idea I have, and I agree with you about, are we going to be massive inflationary with a tariff shock? I mean, basically, if you step back, we look at the tariffs being implemented as a import consumption tax. We run 7% budget deficits here in the U.S. Our belief is you can't continue that, and we're not alone in that. They need to raise money. They have to figure that out. One way is tariffs. What that will do is basically kind of bias things away from goods, make them more expensive relative to services. Reshoring will also likely do the same thing.
Right.
So we're trying to understand where that money gets channeled as we continue to grow. We may have a recession here, but eventually we'll come out. And where is the consumer going to channel that spending?
Scott.
Consumer services are interesting to us.
Scott, so sorry, we have to wrap up, but thank you so much for making the time for us. And Brian, thank you for joining the conversation as well. Really appreciate it.
Yeah, thanks, guys. Thanks for having me.
Let's take a look at Toll Brothers maintaining its full-year outlook despite softer demand in the second quarter. The company's CEO saying the long-term outlook for the new home market still remains positive. Joining us now with more, Jay McCanless, Wedbush Securities Senior Vice President of Equity Research. And Jay, you've got an Outperform rating and $175 price target on Toll Brothers. Talk to me about your reaction to the print here.
Little surprised. Thanks for having me on. Little surprised the stock isn't up more. It was a pretty handy earnings beat, and I think if you look at what they said about demand during the quarter, February was actually their weakest month, and then they saw order demand pick up in March and April, and has continued at that same level at May. So that was really our big fear going into this print, was that April was going to be soft and May followed, but it's actually the reverse of that. They also said on the call that they're increasing their stock repurchase up to $600 million this year. $400 million of that is going to be spent in the back half of their fiscal year, which ends in October. So little surprise, stock's not up more, but longer term, still very positive on this name.
And talk to me about where they stand in relation to competitors. If Toll Brothers, as a luxury builder, had these decent numbers that you're saying, are they more protected than other home builders in the luxury space?
I don't know that they're necessarily more protected, but I think if you look at their customer mix right now, roughly 70% of that customer mix is not completely rate independent. But what management said on the call today is that buyer who doesn't necessarily worry so much where the rate is has really had a crisis of confidence, especially at the beginning of their fiscal second quarter. That confidence seems to be improving somewhat, and management didn't put a number behind it, but said if they can get confidence back up for more of their consumers and maybe get a little help on rates, that there's plenty of underlying demand out there for the houses. And I think that's very much in line with what we've heard from Toll's competitors, both the move up and the entry level, is that the demand's out there. We just need some of the headlines to settle down and need affordability, especially for that entry level buyer, to start working in their favor again.
And my guest host, Brian, has a question for you as well.
So, Jay, we've already seen some challenges at the lower end consumer over the last few years. What would give you concern for the high end consumer? They say it's when the high end consumer rolls over where you really start to get concerned. So what would you be watching for?
Well, I think what Mr. Yearley gave us on the call today in terms of consumer confidence, maybe putting a little more emphasis on that than we have in the past with Toll. Historically, it's always been, you watch what the stock market does, and that usually drives Toll's orders for the next couple quarters. And they affirmed that relationship on the call today, but it sounds like just general confidence levels may be more important to that buyer right now. And then, at a more base level, it's all about the jobs. If you don't have a job, you can't get the house. And I think that's whether you're a high-end consumer or low-end consumer, that's the same math for everybody. So far, the jobs picture has held up pretty well, but any slippage there is something that can make us more concerned about Toll and some of the other move-up names that we like at these levels.
And beyond the near term, we always hear in this country about not having enough homes. Is that accurate, and how do we quantify that?
It is accurate. I think depending on the economist you ask, it's somewhere between 2 million to 5 million homes that we're short in this country. I think especially if you look at what household formation's been doing the last 3 years. We've certainly continued to underbuild relative to that. But I think the problem that we have here in the U.S. is that it still takes a long time to take a farmland all the way to a finished lot. Lots of permitting challenges along the way, some NIMBYism in there. And until we find ways to address those, I don't think we're going to catch up with that gap. So, yeah, I think there's a gap there. It's a pretty wide range of different opinions, but I think for the home builders overall, it should still be a demographic tailwind for them, again, assuming that the job picture holds up.
And Jay, final minute here, but it makes me think about the economic data. There's been this idea that the spending of the ultra wealthy is perhaps hiding some economic weakness going on in the other majority of the population that is struggling a little bit. I wonder to what extent that shows up in some of these names that we're talking about, like a Toll Brothers. You mentioned that you're still looking for that recovery in more entry-level inventory sales. Is that a potential canary in the coal mine for a company like Toll Brothers, or can the continued spending of the wealthy cover any weakness in that lower income group?
So far it has, but it's, I think it's certainly if we were to see the low end get even weaker or mortgage rates go up, we're sitting at a 7 handle now on the 30-year. If we go back to an 8 handle like we saw back in 2023, that could be something that really challenges the low end. And then again, if we were to see some kind of slippage on the job side, but at this point for Toll specifically, their higher end customer is carrying the weight for the lower end consumer. And I think Toll also said on their call that they're going to be reducing the number of unsold homes that they start, just trying to be a little more conservative with the balance sheet and knowing that the entry level and call it first move up consumer is facing some challenges right now.
Jay, really great overview. Thank you for making the time for us this morning. Appreciate it. And thank you, Brian, for joining the conversation as well. We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. Google announcing it is rolling out an AI mode chatbot for its search engine as competition from AI startups like Perplexity and, of course, ChatGPT continue to threaten Google's search engine dominance. Here to discuss AI's growing dominance in the broader startup space and tech more broadly, I'm joined by Joe Kaiser, CEO of Mercado Partners. It is a growth stage investment firm with over $1 billion in assets under management. Joe, it's great to have you. Thank you for coming in.
Thanks, Madison. Pleasure.
I want to get your take on Google here. It seems to me that they still do need to convince investors that they can win this AI race. Do you think that they're positioned to do that?
I do. I think at the end of the day, they have almost 2 billion active users using search every day. Mm-hmm. And so you think about the power and the value of having those glued eyeballs and users. It gives them the ability to take their time, get it right, and then roll out, as they've talked about in the last couple of days, roll out their new AI platform. And I think the big driver here is that Sergey is very much back engaged and is focused on the AI side of the house at Google.
And we know from a slew of headlines over the past couple of weeks that there is a search engine issue when it comes to AI as a competitive factor for Google, people using ChatGPT instead of Googling stuff. To what extent do you think Google is positioned to overcome that issue?
I think they're well positioned. I think most of us use multiple LLMs. It's not that, although...
Do most of us?
It's
like,
fascinating.
Tell me, because I know I do, but I'm so youthful.
The data
Does
suggests that ChatGPT is clearly the leader, but Gemini's usage is not far behind OpenAI and ChatGPT. So I think they can overcome it.
Brian?
You are youthful. You want to ask the dinosaur over here what he uses?
I'm in my early 30s. Of course I'm using multiple LLMs.
Yeah, I think about it so I'm old enough to remember the early 2000s and late 90s and all the excitement around.
As am I, Brian.
As are you. You look very youthful. So as all of us remember the excitement around the internet, and you could have made a lot of money around the internet, but it wasn't necessarily who you thought might win initially. Right. So how should investors think about this? Do we think there's going to be different winners than we're even considering right now?
100%. I think if you think about how fast the names that we talk about on a daily basis change. So we talked about DeepSeek and then we didn't. We talked about Manus, and then we didn't. I mean, how fast adoption comes in and out, I think gives the opportunity for disruptors to come in and really take hold of the category, where the incumbents, like the Googles and Microsofts, have an opportunity is their scale advantage. So as we talk a lot about the CapEx, the capital expenditure that's going into building data centers, putting compute in the cloud. So I think that is where their staying power lies. But the space, the verticalization of AI is certainly creates opportunities for new entrants.
To this point on the winners and losers, I want to bring up Builder AI, one of the companies Microsoft was backing. They've obviously recently entered into insolvency proceedings. And we have private market data on our platform as well, where investors can take a look at everything from OpenAI to a company like Builder AI. I wonder how you think about the companies that are at that top of that list from a valuation perspective. Are they really better positioned and cushioned than the companies like a Builder AI that are a little bit further behind?
I think we see that the speed of disruption that's occurring is happening so fast. I think one of the things, take for instance vibe coding, which is a friend of mine that was at the recent Y Combinator unveiling of their recent cohort. 40% of the Y Combinator participants were vibe coding. So essentially a non-technical founder telling AI, build this for me. That's how powerful that AI has become. Yeah. So as you think about the barriers to entry for founding companies, that technologies like vibe coding and how cheap, I don't have to buy my own GPU, I can just call CoreWeave or call Lambda Labs and buy a couple hours of time. The cost to building game-changing technologies have come down so much.
Do you think the market beyond just the tech sector has even begun to consider the implications of all of this? I mean, when we look at whether it's healthcare or financials or really basically any sector or industry, is the market priced for what could be pretty incredible advancements over the next decade and beyond?
That's a great question, Brian. I will leave the public market analysis to you, but I would say no. We're not even in the first inning. We're in the batter's box warming up for the first inning right now from an enterprise adoption standpoint. You know, you mentioned healthcare. There are companies like Bridge and Artisight that are really unveiling AI for the first time in healthcare, and they are very early in adoption. And then you think about industries like power and utilities that are trying to solve a massive problem and trying to keep up. And I think in that space as well, and it's a space we're spending a lot of time, which is what new technologies will enable the grid to keep up with the demands, whether it's data centers, EVs, reshoring of manufacturing.
Joe, I want to end on Mountain's set to IPO on Thursday here. What are you anticipating for Mountain's IPO?
I am anticipating a great day. Mountain is led by an amazing founder. His name's Mark Douglas, one of the true innovators in advertising technology, and I would contend one of the true innovators inside of connected TV that we all watch. Yeah.
And anything from you on? I know you can't talk specific names, but in terms of the pipeline, what Mountain's IPO signals?
Yeah, what does it signal?
Good pivot. Good pivot.
I think it signals that the IPO market is opening back up for growth in tech.
Yeah.
All right. Joe, thank you so much. Really appreciate you making the time for us. And a note for our viewers, you can find private company data on Yahoo Finance under the Markets tab, and there you can track everything from valuations to funding rounds and more, so be sure to bookmark that page. Coming up, are investors continuing to look outside of the U.S.? The answer is yes, but where exactly are they looking? We're taking a look at ETF flows. More on that next. U.S. equities underperforming the rest of the world year to date, with the iShares ACWI ETF notching gains over 5% compared to the 0.5% gain for the S&P year to date. So do the numbers back up the so-called sell America trade, and what should investors do about it? Joining us to discuss, we've got Neil Zeus. He is Rareview Capital's founder and CIO, as well as portfolio manager of the Strategy Shares Monopoly ETF for this week's ETF report brought to you by Invesco QQQ. Thank you so much for joining us, Neil. So look, we know that investors are keen on the sell America trade, but I'm curious if you can talk about what you're seeing in terms of the flows here. Where are you seeing the most demand when it comes to equities outside of the United States?
Sure. Hi, Madison. Good morning. Thank you for having me. Great to be here with you. So you're right. The All Country World Index, or the barometer for global equity beta, or the S&P 500 for the global stock market, is outperforming by about 4.5% to 5% year to date. It's a pretty meaningful number. If you were to think about that on an annualized basis, we would get over 15%. And then when you drill down, there are a couple of places that are outperforming, primarily Europe, which takes the bulk of it. So the Euro Stocks Index, if you're looking at it in dollar terms, it would be up around 11%, or in euro exchange rate terms, 21%. So it's having a very significant outperformance. And if you were to drill down further, Eastern Europe, or the Eastern European bloc, especially Poland, which can take the bulk of the flows over there, is really having a substantial outperformance, I think up 40 to 50% of the year on a variety of factors, primarily a release in the tensions around Russia and Ukraine. And so, yes, the answer is inflows are going into international equities, and the predominant beneficiary of that is European equities, and then at a very more micro level, Eastern Europe.
Yeah.
And the question becomes, it's a philosophy question, right? Do you believe in global diversification even after many years of that not working? And that's really the big issue in the industry at the moment. How much do you put there? Is it a head fake like every year, or is this time real?
And this is something my guest host, Brian Levitt, and I were just talking about. Brian, you got a question for Neil?
Yeah, how do the inflows compare to the amount of money that we had seen going into the United States over the last number of years? Does it look to you like, if this trade continues, we're early on in this rebalancing from investors, or has there been a significant move already?
I think that's a pretty fair question. Brian, nice to see you. Thank you. So if this was a baseball game and you had to, translate what you just asked into innings, this would be like the first or the second inning. The reality is that the market caps in the United States are trillions of dollars overall larger than European equities. And so it doesn't take a lot of inflows to move those markets around. And so if this is a real event, and I would define real as not just fiscal expansion coming out of the European Commission or Germany specifically, but an earnings event where companies begin to earn a lot more money, we haven't seen anything yet. And this is, by the way, after a decade of this underperformance. So yes, you may have missed the initial low-hanging fruit, but if you believe in a secular change underway, there is significant runway.
Neil, really appreciate your time. Thank you so much.
My pleasure. Thank you for having me.
Brian, I want to get final thoughts with you. This has been my obsession of the week, the idea that retail investors stayed and institutional left the room a little bit and missed out on that recovery. Sad face, I know. To what extent do you think that's a signal that retail kind of won this first round of volatility in the market? How would you describe the retail versus institutional flows?
Well, we saw $74 billion come out of equity mutual funds and ETFs in April. And sad face, because it's my life's work to try and convince investors to manage their emotions, stay the course, think long term, have a plan. And so it's always a challenge. And the problem, I think the critical problem that investors have is that old saying about it being darkest before dawn, although that's not always true, I've heard. Right. But if it's darkest before dawn, they always tend to be trying to get out of markets right when we're about to get some type of response. Those great days happen. Those great days almost always happen near the worst days. It was like that in COVID.
Yeah.
It was like that on April 9th. And so we miss those best days. We miss a lot of returns. So investors are still their own worst enemies with regards to this.
I'm so fascinated by it, I think, because my sense, and from talking to so many institutional investors, is that they're supposed to know better, but then we saw retail staying. So in 30 seconds, retail, do they have like a stronger stomach right now?
Well, maybe the retail investor has learned over time. I mean, we still saw some movement, but maybe they've just we've been through this so many times now. I mean, if you look if you had told me when I graduated college in '98 that I would live through a tech wreck, a global financial crisis, well, an attack on U.S. soil, or a pandemic, right? I wouldn't have thought that I would be up 12% a year in the broad U.S. market. So maybe we're all learning something here.
And important too in terms of what we're seeing with the Europe flows as well. Brian, thank you so much.
My
As always,
pleasure. This
great
was
to
fun.
have you.
Thank
Thank you
you
so much. A big thank you to you. We're going to have more coverage ahead with wealth dedicated to your personal finance needs. Brad Smith has you for the hour. Stick around.